The stock market is currently closed for the weekend. SOFI Technology stock closed its last active trading session on Friday afternoon, May 22, 2026, at 4 p.m. Eastern Time at an exact price of $15.62 per share, marking a minor intraday slide of 3 cents or a negative 0.19% movement from its previous close. Throughout that final session of the week, the equity displayed sharp volatility, opening at $15.70 before surging to an intraday high of $15.93, only to face aggressive selling pressure that dragged it down to a session low of $15.36 before stabilizing near the flatline on a massive trading volume of over 58 million shares. This minor daily fluctuation completely masks a much larger, counterintuitive reality that has sent shockwaves through retail communities and institutional boardrooms alike. While the broader public markets have been wrestling with macro pressures, inflation scares, and surging bond yields that traditionally crush growing financial institutions, big money has secretly been shifting their positioning behind the scenes. The widespread consensus is that this fintech challenger is losing its edge because its stock has shed significant value from its previous highs. Yet the underlying operational data suggests the exact opposite is happening. Retail participants who rely solely on basic online investing software see the falling chart and panic, but sophisticated operators are looking at a historic milestone that went completely unnoticed by the masses during the recent first quarter earnings cycle. The general sentiment surrounding the SOFI trading platform is heavily weighed down by a persistent expectation that it cannot survive as a true banking giant without succumbing to the toxic credit cycles that plague traditional retail lenders. People look at the stock and assume that because the initial euphoria has worn off, the growth narrative is dead. This negative expectation is precisely why the equity remains highly volatile, creating a massive gap between public perception and actual financial performance. The reality, however, is that the firm just reported record-breaking first-quarter results for 2026, driven by a staggering influx of over 1 million new members in a single 3-month period, pushing their total active user base to nearly 15 million individuals. Even more compelling is the fact that this expansion did not come at the expense of bottom-line health. The firm is generating real net income and expanding its interest margins at a pace that legacy institutions cannot match. Yet Wall Street chose to punish the equity simply because management decided to keep their full-year guidance conservative rather than raising it to satisfy short-term targets. This mismatch between operational execution and short-term price action is creating one of the most polarizing setups in the entire financial sector, forcing self-investing participants to choose between chasing near-term sentiment or holding firm on long-term structural changes. To truly understand the intense daily swings and trading volumes we are seeing right now, you have to look closely at how institutional activity has decoupled from individual retail trading behavior. Over the last several trading sessions, the heavy volume shelves near the $15 mark have acted as a crucial line in the sand for bulls. Every single time macro fears over elevated treasury yields push the broader indices lower, hitting names like Tesla stock or Apple stock, sellers try to break this fintech player below that critical psychological support. Yet institutional accumulation indicators reveal that large blocks of shares are being quietly absorbed every time the price dips into the mid-$15 range. This suggests that while retail traders might be shaking out due to fear, institutional wealth management desks are viewing these lower valuation multiples as a highly attractive entry point. The options chain also reflects this brewing battle, with a massive concentration of open interest in near-term call options that implies a coiled spring effect if the broader market stabilizes. The equity is currently stuck in a brutal tug-of-war between macroeconomic headwind narratives and a flawless streak of consecutive profitable quarters. When you contrast this setup with how other dominant market forces are trading, the divergence becomes even clearer. Consider how Nvidia stock has captured the entirety of the market's attention, vacuuming up liquidity and leaving smaller financial technology companies to defend their valuations on pure fundamental performance. In an environment where everyone is chasing high-flying semiconductor names or seeking shelter in stable individual brokerage providers like a standard Fidelity account, smaller digital banking platforms are forced to prove their worth with hard cash flow rather than speculative stories. For anyone managing a self-directed portfolio or utilizing automated options like Schwab Intelligent Portfolios, the current price action demands deep scrutiny. The stock is reacting violently to every single data point tied to Federal Reserve policy because its core lending business relies heavily on the cost of capital. When inflation data ticks higher, the market immediately prices in a tougher road for loan originations, completely ignoring the massive fee-based revenue streams that the company has spent years building to insulate itself from these exact interest rate fluctuations. This brings us directly to the unique competitive dynamics playing out across different online banking and digital brokerage applications. When everyday consumers look for investment help, they are increasingly choosing between comprehensive modern ecosystems and old-school firms. Traditional powerhouses like Fidelity Investments continue to dominate institutional assets with their massive suites of Fidelity ETFs, Fidelity mutual funds, and established Fidelity brokerage accounts. For older generations or traditionalists, managing capital through Fidelity Wealth Management or securing a retirement nest egg via Fidelity IRAs feels like the safest bet, especially when relying on the stability of the Fidelity mobile app or the complex data feeds of the Fidelity trading platform. On the complete opposite end of the spectrum, you have the pioneer of the mobile trading movement, Robinhood, which has used the popular Robinhood app and accessible Robinhood investments to capture the ultra-casual retail demographic. By offering Robinhood Crypto, automated Robinhood cash management yields, and Robinhood fractional shares, they have built a formidable sandbox for quick trades. Yet neither of these extremes perfectly solves the lifestyle financial needs of an upwardly mobile young professional who wants a single application to handle their checking accounts, mortgage, student loans, and active stock portfolios simultaneously. This specific white space is exactly where SOFI Invest aims to dominate, positioning itself miles ahead of basic trading platforms. Unlike a standalone Robinhood stock trading setup or a traditional individual brokerage account, this digital bank has spent hundreds of millions of dollars building an infrastructure designed to capture a consumer at the start of their financial life and retain them for decades. Comment below how many shares of SOFI you currently hold and what your average cost basis is, because tracking how retail investors are distributed across these price levels is essential to understanding where the next major short squeeze or support bounce could trigger. If you look at how this ecosystem scales, a user might initially download the app to manage a student loan refinancing or to buy a few shares of stock through their active investing feature. Once inside, the platform cross-sells them into high-yield savings accounts, credit cards, and automated robo-advisor options. This multi-product integration creates an incredibly sticky ecosystem. The recent data shows that cross-buying behavior among their member base spiked by over 40% in the first quarter of 2026 alone, a metric that proves their customer acquisition cost is being amortized beautifully over time, leading to higher margins that legacy institutions cannot match. To put this structural advantage into perspective, we have to look at how other premium institutional platforms operate. Consider Interactive Brokers, which caters to highly sophisticated, high-net-worth active traders who require international market access. The Interactive Brokers trading desk and the complex Interactive Brokers platform are widely praised for having some of the lowest Interactive Brokers fees in the entire industry, making an Interactive Brokers account the absolute gold standard for institutional stock trading and global margin connectivity. But your average everyday consumer who is just trying to build wealth, set up a direct deposit, and occasionally buy shares of large-scale technology companies doesn't want or need that level of overwhelming institutional complexity. They want a streamlined, beautifully intuitive interface that rewards them for keeping their entire financial footprint in one place. This is where the tension between expectation and reality becomes most obvious for investors analyzing the company's business model. The market often treats this business as a standard, sensitive regional lender that will get crushed if defaults rise, completely failing to recognize that it also owns Galileo and Technisys, the back-end tech infrastructure pieces that power other fintech apps worldwide. When you look under the hood of the business model, this technology platform segment acts like an internal software factory, allowing them to process transactions, issue cards, and manage ledgers at a fraction of the cost faced by legacy competitors. Instead of paying hefty licensing fees to third-party tech providers, they own the rails. This means that as they scale their member base, their marginal cost to serve each additional user drops close to zero. Furthermore, they are leveraging this infrastructure to launch massive corporate initiatives, such as their recently announced partnership with MasterCard to issue stablecoins and build out proprietary blockchain payment frameworks. If this digital payments infrastructure scales efficiently throughout the remainder of 2026 and into the future, it will unlock massive streams of high-margin, fee-based revenue that are completely immune to whether the Federal Reserve cuts or raises interest rates. This is the massive structural disconnect that short sellers and bearish analysts are completely overlooking when they focus exclusively on near-term loan origination slowdowns or temporary technology platform adjustments. When we look at the older reports and past performance, it is vital to remember how this company arrived at this critical juncture. Emerging into the public markets via a blank check merger during the height of the speculative financial boom, the stock initially experienced a massive wave of hype that drove its valuation to unsustainable levels. Back then, the company was losing money on an unprofitably high customer acquisition spend and was heavily restricted because it did not possess a true national bank charter. This forced them to rely on third-party banks to fund their loans, severely limiting their net interest margins and leaving them vulnerable to market disruptions. The turning point occurred when they successfully secured their formal bank charter, transforming the financial mechanics of the entire enterprise. Suddenly, they could use their rapidly growing user deposits to fund their own loans, instantly lowering their cost of capital and allowing them to generate massive amounts of interest income that catalyzed their march toward consistent, predictable net profitability. Looking ahead, the future outlook for the company is defined for several clear competing scenarios that investors must watch closely as the year unfolds. In the bullish scenario, the company successfully maintains its blistering pace of member accumulation while proving to Wall Street that its underwriting standards are robust enough to keep net charge-offs well below industry averages. If they can comfortably sustain this balance while their new digital payment and blockchain initiatives begin contributing meaningfully to top-line revenue, the current conservative full-year guidance will inevitably be shattered. This would force a massive wave of analyst upgrades and institutional reweighting, driving the stock price back toward its historical trading ranges as a premium, high-growth technology company. Conversely, the bearish scenario cannot be completely ignored. If the macroeconomic environment deteriorates into a prolonged stagflationary cycle, causing unemployment to tick up among high-earning young professionals, the credit quality of their loan portfolio could face unprecedented strain.
If rising defaults coincide with prolonged stagnation in their technology platform sales, the stock will find itself trapped in a persistent sideways consolidation pattern, tested repeatedly by short sellers looking to exploit any sign of operational weakness. Ultimately, the entire investment thesis for the stock boils down to whether you believe the company can successfully fulfill its grand ambition of becoming a dominant financial institution over the next decade. The market's short-term focus creates a continuous loop of noise, tracking every minor blip in interest rate expectations and punishing the stock for macro factors it cannot control. But when you strip away the daily market volatility and analyze the raw fundamental trajectory, the reality of a highly profitable, rapidly growing digital financial hub stands in direct contrast to the beaten-down chart pattern. The structural advantages provided by their proprietary technology platform, combined with an unparalleled ability to cross-sell financial products to an incredibly loyal and upwardly mobile demographic, suggest that the gap between public expectation and operational reality cannot remain wide forever. As institutional accumulation continues to solidify floor support levels, the patience of long-term investors